Hello, everybody. Thank you guys for joining us today. We got a good one on par for you today. I am Noah Rosenblatt. That is John Walkup. And with us is our esteemed colleague, Jonathan Miller, self-proclaimed master of the universe. I didn't forget. I did not forget that, Jonathan. Even though you didn't have to tell me, I remembered it still myself, all on me own. Okay.
I'm impressed.
Thank you very much. That's it for me. All right. Jonathan is the president and the CEO of Miller Samuel, a real estate appraisal and consulting firm he founded in 1986. I'm not good at math, but that's like 38 years ago. So this guy has some wisdom and experience under his belt. He is a state certified real estate appraiser in New York and Connecticut. He performs court testimony as expert witness in various local, state, and federal courts. He's an appraiser A, member of the real estate board, and the former two-term president of RAC, a premier appraisal organization. This guy does everything. He also publishes a daily housing notes letter on critical notes on the state of the market. John, I believe you're going to put a link to that housing
I'm
notes.
sending that in the webinar chat right now. There we go.
Thank you very much. So
Hey,
that
thanks,
link,
guys.
very welcome. It's a great thing. And if you don't get, it's free. Don't cost nothing. If you don't, there's a link right there. Get on his platform, hear what he has to say. But for now, I got a bunch of questions for you, Jonathan. I'm going to go right into it because the people want to know. Let's start out with the most asked question. What is going on, the general state of the Manhattan and the Brooklyn market? Or is it a buyer's market, seller's market, price action, leverage? Tell us everything that you're seeing in the market today.
Sure. Well, first of all, thanks for having me. This is always super fun. You guys are really fun to banter with because you really know what you're talking about. So I love doing these. The way I think of New York City or Manhattan and Brooklyn specifically is it's waking up. And it was waking up before the 50 basis point cut by the feds. In fact, the Element new signed contract reports that I do for Brooklyn and Manhattan saw big year-over-year gains in both July and August. And in fact, in August, if you blend, because we look at co-ops, condos, and 1 to 3 families together, they're up about 30% year over year in Manhattan and 50% in Brooklyn. Now, a year ago, clearly, softer or soft, not softer, but soft. And what I think it's sort of a precursor to the Fed, what I think is going to happen with the, going forward over the next 6 months with the 50 basis point cut that we just saw. We're sort of like, there's been like a slumber for the last 2.5 years or so where people were interrupted mid-boom by the steepest ascent in mortgage rates in about 5 decades. But on the other hand, I don't think this is going to be some record-setting frenzy like we had during the pandemic, because still mortgage rates are double what they were during sort of the low point. You're talking, 6-ish versus 3-ish, right? But it's not 8-ish. And so I do think we're seeing sort of an incremental improvement in the market, but that's not even sort of the half of it, because we're looking at another rate cut in November, another one in December, and then probably 4 25 basis point cuts in 2025, which is the combination is weird because unemployment is still in the 4s, right? You would think it'd be in the 10s to have these kind of cuts. So, because I don't know about you, and this maybe didn't apply during the housing bubble, but you actually need to have a job and income to buy a home if you get a mortgage. And so, the economic numbers still are relatively good, or not relatively, are good.
Well, let's talk about the Fed. Let's talk about the cut. Let's talk about moving forward. I mean, you're right. I mean, it looks like right now, as it stands, the market's anticipating a 50 basis point cut in November. Looks like they want to see it all the way down to 3 to 3.25 or so. Are we going to see a return of the ninja loans, the no job, no income, if we get down that far, Jonathan? What, in your broken crystal ball, how do these Fed cuts impact the market?
Yeah, the one that's held together with duct tape. So first of all, I think that lenders at least initially learn their lesson from being devoid of all underwriting during sort of the heyday of the housing bubble. But I wouldn't put it past them to see, some bad behavior emerge over time. But I don't think that's going to be a force of nature like it was before. What's really interesting to me, and maybe you guys know more about this than I do, but what I find really amazing about like the discussion about housing now is that if we had this call in July, it was very different. What really changed the sentiment about rate cuts, which is then changing the sentiment about housing, is the first week of August, we had this in Japan, the yen carry trade, which is like way over my expertise. But what it did was it caused sort of the world to look at the odds of a recession and be a little bit more concerned about them. And it was probably overhyped in the beginning, but what we did effectively was go from, hey, we're going to have 125 basis point cut in September if we're lucky, to the three big banks, Wells, Citi, and JP Morgan, said we're going to have 125 basis point cuts from September, totaling up September, November, and December, to roll out the year, which is sort of dramatic. And then the first cut ends up being 50, and now JP Morgan, saying, hey, we told you so, and we think the second cut's going to be 50 as well. Even though I think it's like 50-50, whether it's going to be 25 or 50,
Yeah.
I would hope it's going to be 50, because I like to see it's been a long 2.5 year slog, and it's sort of to wake things up in the housing sector, even though the Fed isn't only looking at the housing sector, obviously.
Right. And Jonathan, if I could just go back to that first question, just on the state of the market, please. I'm just curious to get your thoughts. If you could just talk on price action a little bit, and whether or not you see any leverage bias towards the buyers or sellers based on the information that you're collecting at the top there.
Sure. So are you saying that I went off on a tangent, random, just sort of a
No,
random
no, no.
conversation?
I just
I
want
was
to
right
make
there
sure
with
that
you.
I want to make sure that people get what they need to hear. That's all.
Understood. So I'm not seeing any sort of change in direction. I'm seeing, pricing generally is lower than it was 2 years ago, 3 years ago. But I'm seeing sort of, it seems like things are stabilizing a bit. And to me, that tells me that over the next couple of years, prices are going to rise in a very moderate way, not in a, because inventory has not been the issue in Manhattan and Brooklyn like it has been in Westchester or Fairfield, the outlying suburban markets, which are, at 40-year lows in some segments in terms of supply. Even with the inbound supply that has come in, it's still, dwarfed by pre-pandemic sort of numbers. So as a result, I think Manhattan is probably in a really good place where there's going to be product to sell. I think the reason why a lot of brokers will say things like there's not much inventory out there, it's because I do believe that the inventory that has come in is priced too high or aggressively, if you wanted to sort of super generalize the new product coming in. So it feels like there isn't a tremendous amount of competition. We're only seeing this is second quarter, we saw 5% market share of bidding wars. Normal for me in tracking where you have sort of housing prices rising with inflation, bidding war market share is 5 to 7% in Manhattan. Whereas all the suburban markets out, surrounding the metro area, you're talking, they're off. They used to be around 40 to 50%. Now they're 30 to 40% of the closings are above the asking price. So that's coming down because there's a little bit more supply, but it's still ridiculously out of balance.
Yeah, I feel like the suburban, outside of our little bubble of New York City, the suburban markets, especially in the Northeast, right? Because it looks like the different quadrants of the country are doing different things now. But I feel like the Northeast has held on for a long, long time, really tight market. But
Yes.
I'm more curious about these rate cuts that you talked about before I interrupted you to go back to the
You
other Manhattan
corrected me.
question. Oh, no. I don't correct you, correct me, sir. But in your opinion, how do these rate cuts affect price valuations? Is there a relationship there, or
Yeah.
what do you think?
Yeah. So what we learned during the pandemic was that low interest rates make housing less affordable, because it essentially eviscerated supply. And so I think the way I'm going to sort of answer this question in a roundabout way, because what I think of this is, the lock-in effect, the idea of homeowners aren't putting their homes on the market because they are enjoying a 3% 30-year fixed, and now they'll, it'll be a 6% 30-year fixed. So, they all of a sudden they become buyers, so they're not listing. Well, we're seeing listing inventory rise, so seller resolve is eroding, and also buyer resolve to wait until rates are lower is eroding as well, because they've been waiting, many have been waiting for, multiple years. And I think the other aspect to this is that, beginning with the Fed's comments in December about not raising rates anymore, what they essentially did for consumers was give this sort of thought process that over, 1 year from today or 2 years from today, mortgage rates will be lower than they are today. So what that does is it brings in more supply. Supply's already coming in, more supply, but it also brings in more buyers. So there's kind of an offset, and I don't see the inventory imbalance, meaning the tightness of supply in the region, not so much in Manhattan, as being solved for another 5-7 years, if not longer. I think that it has a long way to go, because rates were held too low for too long, and we're still grappling with the distortion in the market. So all the sort of supply and demand rules that we were, learned in school and whatever, a lot of that is still distorted massively. And so it's a little confusing.
Yeah, I have one more question on rates. When the Fed cut those rates 50 basis points, I think it was last week, it actually, the 10-year yield went up,
Yeah.
and mortgage rates actually ticked up. And we were talking about this on Macro Monday. If you join Macro Monday, we're talking about this. Watch out. It may not go. It was like priced in. It was almost as if
Already. Yeah.
Right. Do you see that as, if the Fed continues to cut, do you think it will have a nominal or not much of an impact on rates? It's already priced into the cake here, or what's your thoughts there?
I think initially it is, and that's exactly right. Like, it's not like, hey, the Fed cuts 50 basis points and mortgage rates drop by 50 basis points, right? I mean, that's not what happened. And in fact, they were down. The Freddie Mac numbers are down like week over week 0.01% or something like that, if I recall correctly. So it's nominal. I think the way we should look at it is that it's going to keep rates, I think, generally from going back to where they were. And also too, I think it will drive rates lower. I mean, I think, first of all, who knows? But
Yeah.
I do think that a year or two from now, we're going to be settling in the mid fives, would be my guess. And that's it. And I literally, in 2020 and 2021, I was saying that, like, rates should be in the fives. They shouldn't be in the twos. This is going to end badly. And of course it did, because it eviscerated supply, because they're just, people don't think of inventory as this organic thing, but it takes a while to sort of, the life phases of the owners of the home, empty nesters, kids going, off to college, downsizing, relocating because of a job, like all that stuff takes time. And essentially it was just wiped clean. And so we're sort of starting over. So I think over the next couple of years, we're going to see rates fall from where they are, but it's going to be incremental and gradual, combined with more supply coming in, but not enough. And, so it's a better condition, but it's not, I see this whole effort over the next 2 or 3 years as striving towards normalcy, whatever that means, right? It's like we're getting out of, I had a funny thing in early 23. People were asking me, what do you think about 23? And I said, it's going to be the year of less disappointment. And, because I'm a marketing maven, right? What's more
That's
positive
that
than
sounds
it's
like the
less
worst
disappointing?
fortune cookie you could ever get. It's going to be a year
Absolutely.
of
I still look for one of those, although I have my favorite fortune cookie thing on my desk at the office, tagged on my board. It says, there's no time like the pleasant. I mean, come on. But anyway, I just think we're sort of in this slow motion improvement mode and nothing more. It's not like this earth-shattering explosion, but it's definitely on a
We're
positive.
already at 1.5 year lows with rates. Like they've already
Yeah.
come way down.
Absolutely.
So, Jonathan, on the back of that evisceration of supply and the slow rebuilding of it, how does that filter through to the rental market? Because is the same push-pull still in effect? And what do you see there?
Yeah, that's a great point. So the simplistic way, because that's how my brain is very simplistic. I look at whenever mortgage rates in this cycle fall, rents fall. And the reason why I think that is because, and in fact, our Manhattan rental market for the last 5 months, median rent has fallen year over year. And it's not that rents are falling and they're going to be dramatically more affordable. They're just not going to be at record levels that they were a year ago. The record was set a year ago, prior to August, and July was this year's high. It fell short of last year and then started falling in August. And I suspect with mortgage rates falling, that we're going to see rents falling. The reason for that is because the rental market generally in the city is already, sort of the default position is tight or, almost tight. And then when rates went up, it pushed people on the fence into the rental market, which sort of, caused all this, straight up, into the right pattern of rents, which I don't think is quite there anymore. And then the other thing, we're seeing that nationally. I mean, I don't cover specifically, but I follow, rents are definitely, the growth rate across the US is coming down. If not, we're not seeing that much decline, but we are seeing growth sort of go away.
Yeah.
So rents are, I'm sorry. So the bottom line is rents will probably soften a little bit over the next year. If I had to bet, if rates continue to, stay where they are, or decline, but they're not going to correct. Like there's a big difference between decline and correct.
Right. Yeah. I mean, they've come a long way, right? I mean, I think
Yeah.
there's a lot of renters hoping that they'll come way, way down. And, barring any kind of crazy thing going on, it may just soften as
Yeah.
opposed to correct.
Exactly. I mean, so for example, we're seeing in Manhattan, 1 out of 5 apartments are rented for more than the landlord's asking. And in Brooklyn, 1 out of 4.
Yeah.
So, yeah, the rents aren't rising with the intensity of before, but they're still high and it's still tight. It's just not as tight.
Yeah, that makes sense. All right, this is one of the biggest questions we get all the time, the election cycle and its effect on real estate markets. I mean, here we are in fall. A lot of us have said there's massive uncertainty out there. John and I on Macro Monday talked about 3 big uncertainties in the last few months. We talked about interest rate uncertainty, geopolitical uncertainty, and the election uncertainty. I feel in the last 7 or 8 weeks, the interest rate uncertainty has faded out. And as a result of that, buyers have come back in. So we're seeing a nice pickup right now, which for a market that's been down and out for 2 years, it's refreshing to see it. But what is your thoughts of the election cycle on real estate markets? And is the run up to the presidential election holding us back? Even with the recovery we got going on now, would we be at a much higher place if there was no election going on?
Yeah, so a while ago I looked at the co-op market in Manhattan, which is not representative of the United States, right? And at least, I'm assuming that. I guess if you're a true New Yorker, you think that that is, all that matters. But the idea is that the way I think of it is, I went back to 1990 and I looked at co-op transactions. I picked co-ops because they're the largest form of housing stock, and there's not new development in the mix. That new development closings are sort of random based on when the C of O is delivered, when they can actually close, which isn't necessarily a market phenomenon. Maybe the contract is, but not the closing. So I just looked at co-ops, and what I found going back to 1990 is I broke the world into even and odd years, even being federal, presidential, and midterm elections, odds being the year in between. And essentially, what I got out of it was that in an even year, that from July to November, sales pull back, but then there's a big release in November, December, January, sort of a catch-up period. There doesn't seem to be an impact on price. It doesn't seem to matter whether it's the party or the candidate that wins or loses. It just seems that it's another, like you put it a good way with your, the variables that people are sort of processing.
Yeah, the uncertainty.
It's a variable that gets removed. It's not that it was preventing someone from ever buying. It was that they delayed their purchase until after there was sort of a check mark that question was answered. It didn't matter what the answer was. It mattered that it was no longer a question. Because a lot of times in confusing periods, economically, the delays on transactions go away after an event occurs just because people, say, hey, the world's not going to end, but maybe 2 weeks ago I thought it was. And I think that's all it comes down to is removing a variable.
Let me follow up on the uncertainty question, because I think there's, we've been talking about the election. That's sort of a headline uncertainty, and there's reasons for that. We had a lot of economic uncertainty coming into this. It seems like the Fed has sort of put a damper on that, right? They've capped inflation. We're trying to get a sense of what the employment situation is. So we sort of kind of put one sense of insecurity on the side. Now we've got this, election uncertainty. We also have now a local version of this uncertainty, which is,
Yeah, that's a new one.
as we speak. It's new, but I'm curious, at what point do these, these uncertainties, do they funnel down? Is it more local, the worse it gets, and the macro is a little bit better? Or, should we be more concerned about what's happening here?
So yeah, so I'm not sure. I guess it just depends on how loud the signal is. It's not like, hey, a mayor being indicted for the first time ever, that's going to cause people to pause. But on the federal election, I think it's much more influential or sort of in the zeitgeist, and it's been in the zeitgeist for a long time. Whereas this is like yesterday with the mayor. So I'm not sure that local, almost in many ways, I remember someone talking to me. One of my sons lives in Florida, and there's Hurricane Helene is coming, and people in Florida seem to, it feels like the rest of the country's more worried about the people in Florida than the people in Florida are worried about the hurricane. So sometimes you wonder if sort of the national sort of news cycle and everything is much more, it's much more abstract, as opposed to, you're there and you see firsthand what the risk is. Maybe the national is more influential on local home buying decisions than it really should be. Would be my takeaway from that.
Yeah, there's no shortage of news lately for us.
Oh, yeah,
Um,
it's every day. Yeah, I mean, there's
it's
something.
Jonathan, I'm getting asked, by the way, you guys got questions, you got a Q&A right here. Just type your questions in there, we'll do our best. But I'm getting a lot of questions about the state of the new development market in New York. Could you just speak briefly about that?
Yeah, so what's really interesting about new development is for like from the financial crisis through up to the pandemic, right? The story was oversupply. I mean, it was just, there was just a lot of product. And then the pandemic sort of, we went from in 2020, we had an 8.3 year sellout, meaning it would take 8.3 years to sell all unsold new development condominiums. It would take 8.3 years to sell it all out, assuming no new product came in. Now it's about 3 years,
Wow.
because the oversupply, the massive sort of buildup was, I wouldn't say wiped clean, but 3 years is about normal. And so the problem now, I think, is going to be going forward, the lack of product that's going to come in. At least there's this period of high interest rates. Deals don't pencil out like they used to. And the biggest challenge in new development is land, because, the landowner, I mean, they take years to sort of come off their number, and they don't sell if they don't need to sell. Like, it's funny, in other markets, other regions of the country, land is much more, I'm not saying land here isn't speculative, but a lot of the big parcels are owned by families for generations. It's not this sort of flip and turn over kind of thing that you see like in Miami, or in other housing markets. So I guess I'm not sure what the message is, other than I do think that supply is going to be challenged in the next, 4 or 5 years. It's
Yeah, I was just
it's
gonna say it takes years, right? And there's,
for like figure 4 years on average from sort
yeah.
of conception to marketing, and actually physically selling. And so I just think there's we're gonna there it's gonna be somewhat lean in terms of the product that's available. And I think the fact that this spike in rates for the last 2.5 years and pullback by lenders, is probably also slowing the pipeline, going to keep the pipeline slow for the next few years as well.
Yeah, and I don't really, I haven't seen the data lately, but I don't think permits are surging. I don't think applications are surging. So it's not like there's any leading indication that there's about to be a boom in terms of development. We're still in that low build out. Again, construction credits going down, permits
Correct.
seem to be suppressed. So like, there's nothing on the horizon that is saying anything will change from a tight new development market.
I mean, I think what would help it is if the dollar suddenly got really weak and there was a major currency play like we had like in 2006 or 7, but we don't have
Right.
that. So
Interesting. Okay.
So the nice thing about the new devs, right? You get that punch list walkthrough, but I'd like to pivot to the exact opposite, which is, let's say it's an unrenovated co-op, right? How does, when you're doing appraisals now, how are you factoring in renovation costs? Are we still looking at lead times and outrageous costs? What's the latest there?
yeah, there's still a big premium between unrenovated and renovated for the reasons you just said. One is cost, and one is, I mean, we can get silly with, high-end Fifth Avenue where summer work rules, which are so bad for values in those buildings. Like, it is such a short-sighted approach. It's like, hey, I don't want to be inconvenienced by all the noise, but what you're doing is making somebody renovate for 4 summers. And they're going to pick a building that you don't have to do that. So yeah, I mean, we look at, I know you probably look at it more on a per square foot basis. For us, we tend to look at it more on a percentage basis, like what it actually adds to value, as opposed to just the incremental, whatever the construction costs are. So we tend to see about a 20% premium for something renovated versus something that, you know, just like it could be like a state condition, I guess is the word I'm searching for. But it could be much higher than that. I'm just saying on average about 20%. It could be 40%. It could be
Right.
10%. You can walk in and it's like all the finishes are Home Depot type quality
Glaze your
on
mind.
on a big apartment, and you can walk in and it's like gold plated, whatever, wildly overspent on a renovation where it doesn't provide a premium. So generally speaking, the premium outweighs the cost of the renovation, bottom line, as a sort of a general comment.
Right. I just want to follow up on that because one of the things that we've heard from agents is that I suppose the rate at which a renovation sort of fades over time has sort of constricted. It used to be maybe like 10 years, it's still okay. Now it's almost like 5 years, like, oh, it's 5 years old. I got to
A
renovate.
faster turnover, right?
Right.
Yes. Yes, I would say I don't have any numbers on that. I just did a thing on resales. I was just looking, and the higher you go in price, the lower the probability of a resale. In other words, that it makes me think that the bigger properties, once they're renovated, they maybe go longer than a smaller, not a like a studio, but like something that's not, Fifth Avenue fronting the park, that's, 5,000 square feet. There seems to be more turnover below the top of the market, I guess what I would say.
Yeah, and I was just in Phil Horrigan's roundtable discussion earlier today, and there was anecdotal reports from the agents on that panel that, again, 5 years, if there's a renovation that's more than 5 years, it's already considered dated by the buyers that are coming in. It used to be longer than that, and now it's just like, unless it was done 3 years ago, they're not considering. But
that feels like a pandemic thing, to me, where people actually were in their apartments for a long time and really actually looked at it and are more cognizant of it. I don't know if that is a long-term pattern or not. I would doubt it, but that I have heard that. Yeah.
I got two follow-up questions on the renovation thing. I mean, this is a thing that people, I think, need to hear from you. Number one is, it used to be per square foot when I was transacting in there. And I mean, I'm tripping back 10, 15 years ago now. Like, so bear with me here. Like,
sure.
2008. Yeah. I mean, it used to be like $300, $400 a square foot was like a premium. And now I'm hearing like numbers just being tossed out there, like $1,000 a square.
Yeah, $1,000 a foot.
Did we just skip everything in the middle and just we decided to go over there now? Like, I mean, but is that realistic? I mean, because I feel I would like to know if you think that level $1,000 square foot is like, is it too much? Did we go too far? And number two, I mean, there's a diminishing return with these things, right? I mean, like if you have a 1,000 square foot apartment and you put $1 million into it, you're not gonna get all
versus
that
$1 million into like a 12,000 square foot townhouse. That got you like a couple bathrooms and maybe some new plumbing.
Yeah.
No, I mean, it's pretty common in townhouses. It's well over 1,000 a foot. We're seeing, in like gut rehabs, 1,200. I mean, those are the kind of numbers we're seeing. I think like, build out new construction of a multifamily, they pencil in like 500 a foot for like ground up, but the rehabs are much higher. I think, 500 to 1,000 a foot is the typical range of construction costs for three reasons. One is, it's not like it was 15 years ago, but also labor and materials are noticeably more expensive. There's a labor problem. And then, we still have some supply chain issues still languishing from the pandemic.
Yeah, speaking of which, I mean, a lot of this falls on the shoulders of the co-op market. And, one of the things that Don Olshan's been talking about for a while, and I think you've been talking about too, is just the co-ops have in general been penalized simply for their structure, whereas condos, on the other hand, are just tend to depreciate and kind of eating into that market share. And I'm curious, Are you still seeing the softness in the co-op market this year, or how does that look like?
So condos have, especially, the sort of the upper third of the co-op market, it's just been crushed by condos. A couple in their mid 30s, good comp. You know, condo. First of all, the condo new product is higher. Sort of taller, more. Better views. For I mean, obviously it depends on what floor you're on and all that, but more amenities. It's like addressing the new generation, whereas sort of old world Park Avenue, Fifth Avenue, Central Park West is has been stagnant for about 15 years. I mean, if you want to talk about a segment of the luxury market that hasn't woke up in almost 2 decades, it's the luxury sort of, the high end Park Fifth. The numbers are half, or it's
Wow.
incredible. More for your money than a condo, but you give up part of your bundle of rights as an owner to the co-op board. I think every time I'm on here, I sort of joke about the dog weighing ceremony I always want to go to at a co-op that bans dogs over 50 pounds. And what would happen if the dog started gaining
Gained
weight
weight.
after the closing, the doorman's pointing out to the shareholder just bought for cash an $8 million apartment, say, hey, Fido's a little bit getting a little chubby there. What are you going to do about it? Kind of thing. I mean, it's funny, but it's like, that's the way to think of co-ops in the general terms of they have more control over who you sell to and, the rules that they have. It's not that condos don't have rules, but there's a reason why new construction is almost exclusively, unless it's on leased land, is exclusively condo. And it's because condos, pound for pound, amenities are identical.
Yeah.
They sell for more because of the ownership type, and that's just a fact. I did a study with NYU Furman like 15 years ago. We looked at 100,000 transactions, and that's exactly what we looked at. It's the rights the board has over you as a shareholder damages your value. That's the nature of co-ops. But
John, did,
on the positive side, is that co-ops are the entry point for first-time buyers into the Manhattan market. They're less expensive. You know, most boards are 80% financing allowed. It's the Park Avenue all cash stuff or 50% cash stuff that I don't want to stereotype over the entire co-op market, which is, because it is a great inventory source for first-time buyers, and it's more affordable.
Right. And I have a follow-up, and it's sort of like one of these chicken and an egg ones, because you're absolutely right. Over the last 15 years, I mean, the price appreciation for some of these renowned corridors has not been what it has. And I'm wondering if that's due to the fact that we have all these new neighborhoods now. Like suddenly you can live in Brooklyn and still be considered a New York success story. You don't necessarily have to be on Park Avenue and 65th Street and go to the Met Opera Gala. You can go to BAM. You can go to these other things in Brooklyn. You can live in Williamsburg or Greenpoint on the river in a condo. But I wonder, is it the destination and the amenities, or is it the fact that they're co-ops? And if you think, I'm just curious here, if some of these Fifth Avenue, Park Avenue, Central Park West buildings converted to condo, do you think you'd see an influx of, and this is just a hypothetical.
Yeah.
Influx?
So I think because we've actually worked with a few buildings over the years, coming up with valuations for that, and there's clearly a premium, but the pain and suffering the shareholders have to go through. First of all, they have to all pay off their mortgage. And, and that's everybody, 100%, and that's not realistic. I do think that, condos as a form of ownership have just gained popularity, I think because of the board and, the difference between the ownership. So for example, when I first moved here in the 80s, the co-op condo relationship was 80, in terms of sales, was 85 I'm sorry, housing stock was 85-15, 85% co-op, 15 condos. I mean, the first condo came in the early 60s with the Saint Tropez on the east side, 340 60. I mean, and it wasn't well received. It was, my God, it's not a co-op. And then in the 90s, the ratio was about 80-20. And then about 5-7 years ago, it was 75-25. Now it's like 74-26. You just see this constant shift towards condo in the mix at the expense of, it's not that co-ops are shrinking in units, but their market share of total units is decreasing. Why is that? Well, it must be because condos, for as far as the new product coming in, are more popular or easier to sell, or for whatever the reason.
Yeah. And by the way, guys, if you have your hand raised, stand by. We're gonna probably get to that towards the end. We got just a couple of questions. I got a speed round here. I want to put Jonathan through the ringer with that, and then we'll end a few minutes early and we'll get to questions. Jonathan, 421A, any potential replacement for 421A that you have heard about?
Nothing I've heard. So, and again, 421A, which is sort of the catalyst for new development. I've sort of view it as necessary for the success in new development. But I think one of the reasons it's needed is it enables developers to ultimately pay a little bit more to landowners who have baked in their land value, assuming that the project gets a 421A abatement. So ultimately, politically, the benefit isn't really to make the properties more affordable. It's to make the landowner get their number in order to create this opportunity for which creates jobs and all that kind of stuff.
Right.
I'm not saying the abatement, I think in this world is necessary, but I think the reason for it is not the way as advertised, would be my take.
Yeah, that makes sense. Okay, let's go ahead and do some fire round. So that means that we're going to have 60 seconds or less to answer these questions. We only got a batch of them. And then I got a couple people with their hands raised. And if you guys
Sure.
got questions out there, you can raise your hand. Give me a moment to get to you. Let's go through this and then we'll get to you. But be ready and I'll call on you and get ready with your question. But for now, this is a widely asked question. I get this at least a couple times a week. Is now a good time to list, or do I wait until March?
Right. So the appropriate caveat for anybody answering this question is, in air quotes, it depends. So I personally am not a believer in timing markets, because the reason you would wait until to March is because the buyers are coming out. There'll probably be a couple more rate cuts. The buyers are coming out, but so is everybody else. So there's more competition. So my just general feeling is, if you're ready to sell, then sell. I don't know if there's a perfect moment or not, but that's just my opinion.
Okay, that's good enough.
All right. Next, how do you compare the real estate taxes or the maintenance when you're doing an appraisal?
So in the case of a condo, you mean like common charges and real estate taxes?
Right.
Right. That's what we look at. We look at that in its relationship to the size of the apartment and the floor level that it's on. So for example, in a co-op, the shares are allocated higher as you go up but so that means the maintenance for the same line is higher, right?
Mhm.
Whereas in a condo, it's usually by square footage. So, the sort of default is, how proportional is it to the square footage, if that's an answer.
Okay.
Close. It's close enough. We'll accept it. We'll accept it.
I'll accept it. What will shift what could shift the rental market towards affordability?
I think a massive recession, massive, where there's substantial job loss, then rental prices will come down. And who wants that?
Right.
Right? It's like, I don't personally, unless there's another black swan event like COVID, where it just comes out of left field and devastates the economy and whatever. But who wants that? Right? honestly, like I probably told you before, like I remember, I don't know, like 10 years ago, I was writing an article and I was looking at housing conditions in the 20s in Manhattan, and people were complaining about high rents. And then and just like it was, in the Times, I was, reading all the archives. In the 30s, they were comparing really lots of complaints in the 40s, the 50s. It's just it's unfortunate, but it's like this permanent condition because we have to build a lot more housing, which I'm a very big proponent of, but it's so hard to do that
Yeah.
it's just seems it's always going to fall short and rents are always going to be on the tight side.
What about a scale back or a rollback of rent regulations that happened
Well,
in
that would
2019?
make rents much more affordable. So think about this. This is my attempt at an analogy. You have a bathtub, you have split in the middle, you have a piece of plexiglass, and you have one side is twice as high. That represents higher rents than rent stabilized. When you lift it up from the middle, it equalizes, right? So the people that are being protected pay more, and the people that aren't pay a lot less. And rent control and rent stabilize just makes free market rents dramatically more expensive because it crimps supply in a big way. That's just a fact. I'm not getting into the politics of why
I think Argentina is doing that right now.
I was just going to say there was just an article about that. They removed rent controls
Yep.
and free market rents have dropped. All of a sudden there's availability and
Yeah.
there we have it.
All right, now we're going to shift over to, common charges, maintenance, and looking at the inflation of those, especially in light of insurance and some of these other big costs coming down the road. What's the general trend look like in terms of what the maintenance or just the ongoing carrying cost for apartment are, and how do you kind of look, how does that look, going out a year or so?
Yeah, so the chart is up and to the right pretty steeply for both co-ops and condos. I actually have a chart on this on my website where we chart for condos, common charges and real estate taxes together, and co-ops the maintenance. We do it per square foot and then the average, just based on what's sold, not the entire housing stock, but just each period what's sold. And I remember back in the day in the co-op market where the average maintenance was like 80 cents per square foot. Now it's like two and a half, almost, two and a half, $3 per square foot per month. It's a big number. So you throw in more climate disruption, a lot more insurance problems. In fact, I just wrote in Housing Notes the other day, 2023 had the most, adjusted for inflation, by far the most billion-dollar sort of weather catastrophe events. And like California has wildfires, Florida has floods. You know what the most expensive relative to home values are? It's tornado insurance in the Midwest. Even though housing prices are cheaper, relative to housing prices,
Hmm.
it's more expensive than wildfire and flood insurance. So every region of the country is being impacted by this. And then you factor in HOA fees, going up because their insurance costs are going up, right? Look at Florida with, the Surfside disaster, and now, there's a lot more costs associated with that. So, cost of home ownership is definitely being challenged. So the mortgage rate increase over the last 2.5 years really, took a bite out of affordability in a big way.
Yeah. Did not know that. Interesting. Jonathan, the trend of foreign investors, are you seeing any change there?
No, I'm not seeing
Okay.
much. I think the dollar is just too strong. I mean, the big demand always, it's like South America was Brazil by far, and they're in an economic, they're having a lot of problems economically. China was a huge source, but they've gotten a lot better. First of all, there's more of an adversarial kind of relationship between our countries. So we have, they've really clamped down on getting money out.
Yeah. Capital controls. Yeah.
And then if you look at Europe, Europe, like the dollar and the euro and the pound are like, they're not one for one, but there used to be like a 50% discount on the euro to come here. You're getting, you're paying, your buying power is so much stronger. Now it's roughly at parity. So I'm not saying, there aren't foreign buyers. There certainly are, but we're in a down period for that impact on the market.
All right, Jonathan, you're in a dark alley. It's night. Street lights are out. It's raining.
Uh-oh.
Suddenly, there's an unsavory character. You're cornered, and he asks you, "What's the one thing I can do to increase the value of my house?" What do you tell him?
Is that while I'm running away?
Yes,
Saying
you're
that?
shouting the
Okay.
answer over your shoulder.
Okay. All right. You threw me off there with the dark alley thing. That's going to impact my answer. I think the number one thing, so there's actually two and they go side by side. And it's really what a broker is going to tell somebody when they list the house, but declutter and stay away from the appraiser. Because homeowners, like on a refi or even on a purchase, they're nervous. And so what they should do is have sort of a list of things they did to the house, right? And when you meet the appraiser, you hand it to them and say, "Hey, just want to give you a summary of what we've spent on renovations over the last 5 years. And if you have any questions, just ask me." That's your moment. You don't, because I've done over 8,000 properties in my career. And in like 7,800 of them, the agent told me, "Okay, so this is the kitchen. This is the bathroom. Don't do that. Like, just stay away. Let the appraiser do their thing, but get them up front." And then the other thing you have to remember is because of regulatory changes that began about a decade ago, you can't call the appraiser. Once they walk out the door, you're never going to see him again. You're never going to contact him. So have everything in your hand in a simple list, not this 8-page dissertation in Old English about why your apartment is the greatest thing ever. Just have like 5 or 10 bullet points on a piece of paper and physically hand it to the appraiser and say, "Here's some things that we did." Don't go into detail. Just respect their personal space and let them do their thing.
What about comps? What do you guys get pissed? All right. Do you get pissed if I say, "Hey, look at this comp"?
Okay, so 98% of the time we get comps from a homeowner or an agent. It's a spreadsheet. Let's just say the price is $1 million. It's in contract for $1 million. So there's a spreadsheet with 80 sales starting at $1 million and going up. And so that's disingenuous. The appraiser's going to just ignore it because, they can have other sources, Street Easy, an MLS in their market, whatever. What you need to do is give them something useful, like the house across the street. I don't know what the price is, but I heard it went to contract yesterday. It's a dump compared to mine. You'll see in the listing. Just give them the heads up. Maybe put it on paper. Maybe there's 3 sales. There's a sale of the same unit line 2 floors below a year ago that went for X, but it was gut renovated spectacular. So, we're not quite, but that's why it sold for $1.3 million and I'm at $1 million. Right? Like, It's like you're talking to your friend at Starbucks over a cup of coffee and you're being real. That's what you need to do. You don't need to, I feel like my job as an appraiser, don't take this the wrong way, but I am lied to all day, all my interactions with everybody involved in the sale. Like, I just feel that way. I understand. Everybody's trying to put on their best face and, it's worth $1 billion and all that stuff. But it's better to be authentic and real because then you have credibility. And when you have credibility, the appraiser is going to listen to you. If you don't have credibility, we don't care. Like, because you're just somebody who's, trying to jam this thing through. Just remember that. I think that's important.
That was great. What a great takeaway. I hope everyone listens to what you just said there and adjusts accordingly. I got one more question, and then we're gonna just go to a couple people that have their hands raised, and they've been
Sure.
very patient. Thank you, Jonathan. This is not one of the questions. This is in the Q&A over here. What about the NAR has their new thing, the commissions and the whole? It's a big thing with the industry. I don't want to go into it. You guys are sick of that whole topic. But are you seeing any change or impact on our market in respect to sellers paying those commissions and getting a value back, or not paying them and not getting a value back, or anything?
Right. So first of all, what I'm seeing as a general rule, almost to a person, is nobody is really confident about anything, right? It's a big unknown. You know, there's scripts and there's things to do and how to talk over, a buyer that's misinformed or whatever. But there isn't sort of a locked in, and this is nationwide, talking to, agents in different parts of the US. There's still so much uncertainty. So from that standpoint, I know Manhattan is Rebney or Brooklyn, but I'm just saying from the NARS perspective, they have not communicated clear enough, and I don't understand why. But it's just confusing, and I feel sorry for agents, who are dealing with this sort of, I think, Rebney has worked a lot on this too. I just, I've had lunch with top agents, in the last month, and
Yeah.
it's not clear. It's not clear. So I guess what I would say is I'm not hearing about anything being, you know, it just seems almost like normal course of business.
Like a non-event.
Yes, like a non-event. And maybe that's how it's going to turn out. I don't know. I just know that I'm surprised at how little everybody really feels comfortable with it.
Well, we checked they pulled that data from us. We had it.
Really?
And then they pulled it because there was a whole thing going on. And we did a couple studies, me and John, we did a couple
Yeah.
studies, and it's like 90% of the active listings, or even a little higher than the 91%, something like that, was above 2%. So it didn't really have much of an impact. But
Yeah.
I want to respect the hour, unless you have something to say here, Jonathan, on that topic.
No, that's all I want to say, because I know nothing
Okay.
really.
Okay. Yeah, it's a tricky, mysterious
Yeah.
corner. I got two hands up, and they've been very patient. I don't know if they're still there. Elizabeth, if you are out there, please unmute and ask away. Elizabeth, you are live. You are muted. I don't know if you're still there or not. I'll give this a 3-second thing here. She may not be back. Okay, we're gonna go move on to the next one. Joseph, if you are there, you got the floor. Just unmute yourself and ask away. Joseph, you still there? Oh, they put their hands up a long time ago. It's possible they're not there anymore.
Maybe it's there's a stage fright feature in Zoom, I think.
Okay. Patricia, are you there? Patricia Ellis, you are allowed to talk. If you could unmute and ask away.
I'm baffled by this whole commission issue, which is what Jonathan was talking about. And I got the impression from Douglas Elliman that basically no commission is going to be stated on any listings at all. And our
Right.
approach is to, if I'm representing a buyer, I would have to reach out to the seller's agent to find out if they are at all concerned or interested in paying any type of commission. And if they're not, then the objective is for me, representing the buyer, to ask my buyer if they will pay a commission.
Right.
And it just gets very complicated and
Well,
difficult.
yeah, just to say, to add, I'm sorry, I don't mean to interrupt, but
No, please.
like, so a couple of issues sort of come off of what you're saying. Number one is that the reason why, this is so problematic for the buyer's agent is, the buyer. So think of like typical buyers, like how long did it take them, first time buyers, to build up and save for the down payment, right? And now they have to come up with another 2.5%, 3%, whatever on top of that. but it's not being rolled into the price or the mortgage that they're getting, right? It's like literally out of pocket, right? Which
Yep.
just doesn't, doesn't work, sort of as a general observation. That's number one. And then the other thing though, and this is what the DOJ, Department of Justice, had such an issue with, because this isn't over in the sense that Sitzer Burnett and the class action, like, that's the rule, right? This is sort of consensus, and the lawyers are all going to get rich, doing the litigation on the class action. But the whole issue that this is coming down to is the concept of steering. And so when, a 3% commission appears on a listing, or, 3% on the buyer, and another one's 2.5%, that act is like, hey, the homeowner may be better suited for the 2.5%, but the 3, I'll make a bigger commission. It doesn't matter if that actually happens in practice, it's the perception or the potential. And so it's like this whole thing doesn't feel fixed yet to me. And I think that's why there's all this confusion.
A lot of unintended consequences from this that I
Correct.
think need to be worked out. Thank you, Patricia.
That's
we are
great.
over time. I want to be respectful of Jonathan's time, guys. He already gave us an hour. If you have a question that we were not able to get to, we were trying to answer all those questions that you put up there. Jonathan Miller, you guys can Google him. I don't even know what your email is, John, but I'm sure
Miller at millersamda.com, or you can go to housingnotes.com, and my contact info is on that. And I'm always happy to get feedback and, answer questions if I can. If I can, I can direct you maybe to somebody that can, like
perfect.
Noah and John.
Oh, lovely. Yeah, just bring it over here. And yeah, again, I'm out of time, guys. So if you have any questions and we didn't get to you, I want you guys to ask Jonathan. Oh, you know what? You can email Jonathan and say thank you. Guys, he's a great person to connect with and have as somebody there in case you want to ask a question. Maybe you guys will work together at some point. But this has been very, very nice. Very nice to hear your wisdom and your thoughts from where you are, perched on top of all that information. So from the bottom of my heart, thank you very much. Thank you, John Walkup.
Yeah, thank you guys, because you provide a really great service to the community, and I admire what you guys do. I'm really a fan.
Thank you, Jonathan. I am Noah Rosenblatt. That is Jonathan Miller. That is John Walkup. I hope you guys learned something from today, and hopefully I'll see you guys around these analytics sites and more talks like this in the future. Okay? Take care, everybody, and
Thanks,
good luck
everybody.
out there. Cheers.